Hello. MACD is another indicator we'll cover in this series of tools that are used by chartists when trading in the stock market. Even if you've been trading for a while, I still recommend that you watch these simple and short refreshers because they can really help you out. I will also strongly recommend at this time that you watch the other videos prior to this one so you use RSI, trends, and moving averages before watching this video. You must have a basic understanding of these concepts to grasp MACD appropriately. So, moving average convergence divergence oscillator, or MACD, is one of the simplest and most effective momentum indicators out there. It utilizes two trend following indicators we've already covered, which are moving averages, and it puts them into a momentum oscillator and the way that it does that is by subtracting the longer moving averages, from the shorter moving average. And as a result, MACD offers the best of both worlds, trend following and momentum. MACD fluctuates above and below the zero line as the moving averages converge and cross and diverge. Traders can look for signal line crossovers, center line crossovers, and divergences to generate signals, which we'll cover most of those in this short lesson. I'll also add that one reason our previous lesson was RSI is because MACD is unbounded, which means it's not particularly useful for identifying overbought and oversold conditions. But it makes these two indicators a really great pair for your charts. Here you can see how MACD will generally appear, on a standard chart. However, here you can see what MACD looks like on my charts. Above at the top, you'll also see RSI, which we covered in the last video. In the background of the chart, you'll also notate several moving averages, which we touched on in the finding trends, and then we also covered in the moving averages video. So there are several parts to MACD that I've described here. I'll also show you how these values are derived here, as you can see on your screen. So the MACD line is the 12-day exponential moving average, which we touched base on in our moving average video. Exponential moving averages just give a little bit more weight to the current time frame, or the most recent time frames. At any rate, it's the MACD line, the actual line itself, which you see here as MACD. It's the 12-day exponential moving average less or minus the 26-day EMA. Okay, then the 9-day EMA of the MACD line is plotted to act as the signal line, which you see here in yellow. This signal line you'll use to identify turns and movement in the trend. A MACD histogram, which I've also got on here plotted, that represents the difference between the MACD and the 9-day EMA, or the signal line. So essentially, all that means is that these bars indicate the difference between the length between these two lines. So you notice here it's just barely, and it's a short one. Here the distance is greater, distance is getting greater and greater between the lines. Oh, the lines are starting to converge, they're starting to come together, and you see this come down. The histogram it's positive, or over this zero line here, it's positive. Anytime the MACD line is above the signal line, so anytime this line is above the signal line, it's going to be up on top of the zero. Because the zero line for the histogram just indicates whether it's positive or negative MACD movement. So when it's negative, or the MACD line is below the signal line, as shown here, the histogram will be down below the zero. The values of 12, 26, and 9 are typical settings used with MACD, which I use here and on all the charts that we've added, everything we've covered in our videos so far. However, other values can be substituted depending on your trading style and goals. And as such, my typical, some moving averages that I have, some MACD settings that I have on other charts are not standard. So as the name implies, MACD is all about the convergence and divergence of two moving averages. Convergence occurs when the moving averages move towards each other or get closer, and divergence occurs when the moving averages move away from each other. And in order to keep this initial introduction to MACD video simple and not overbearing, not to cloud everybody, we'll go more into depth on convergence and divergence examples in the next series, and that's where we'll take a more in-depth look on all of the indicators we've covered and are going to be covering. But for now, we'll move on. The MACD line oscillates above. So the MACD line, this line right here, and it's notated on all of my charts. So MACD line, it will oscillate above and below the 0 line here, which is also known as the center line. So people call it center line. These crossovers, they signal something particular, that the 12-day EMA has crossed the 20-60-day EMA. And the direction, of course, depends on the direction of the moving average cross. So that being said, we covered in our moving average video what a bullish order or a bearish order of moving averages is. And so when the moving averages have crossed over and are now bearish order, you'll see that this MACD line will be below the center line or the 0 line. So down here, those moving averages are bearish. It starts to come back up, and when it crosses here, that is a signal to you that without looking at moving averages, that those two moving averages are actually now in bullish order again, and the short moving average is above the long moving average. Likewise, as this crosses up over the center line and the 0 line, and those moving averages do come back into bullish order, that really means that the upside momentum is truly increasing. And as it crosses down, it means the downside momentum is definitely increasing. Signal line crossovers are the most common of MACD signals. The signal line, like I said earlier, is the 9-day EMA of the MACD line. So as a moving average of the indicator, it actually trails MACD, but it makes it a lot easier to spot MACD turns. A bullish crossover, as seen here, occurs when the MACD turns up and crosses over the signal line from below. So we've got MACD line, it comes up and crosses through and over the signal line. And you can see here that price action leads that, which is moving these moving averages, and that creates the crossover and gives you some bullish momentum, which is shown here. A bearish crossover occurs when MACD turns down and crosses below the signal line, which is all notated here. And you can see that the signal, the bearish momentum followed with bearish price action. Crossovers can last a few days, they can last a few weeks. It all really depends on the strength of the move, of the momentum, excuse me. I do want to say that due diligence is required. I hate the word due diligence. I hate the phrase due diligence, but as long as you're using it in a polite fashion, it's okay. But due diligence is really required before you rely on the common signals of a signal line crossover. Because it can give you a lot of false moves, put you in a bad situation if you're not moving with the right time frames. The signal line crossover at a positive or a negative extreme should really be viewed with caution. And I'll go back. If you look here, this looks like an extreme here. This is pretty high up here on this time frame for this MACD. That looks like a pretty good extreme. However, if you look back, it's not really an extreme. Therefore, I'm just trying to say chartists can estimate the historical extremes with a simple visual assessment. I mean, you can just zoom out of your chart and go back and see that this is really an area of extreme for this MACD. So if you want to ask, how high can this go? It just crossed over bullish, and we're down here on that other chart. It looked like it was reaching the max, but in all reality, you can go back and look. Hey, it's got quite a ways it can go. It will take a strong move in the underlying security to push the momentum to that extreme, but it's just something to keep in mind. Even though the move may continue, momentum is likely to slow down, and it'll usually produce a signal line crossover at the extremities. Volatility, obviously, of the underlying security is going to increase the number of crossovers, and that causes a lot of false moves too. So any kind of volatility will give you a signal line crossover. Centerline crossovers are the next most common MACD signals. A bullish centerline crossover, which you can see here. Well, first off, I gave you a bullish signal line crossover. Following that bullish signal line crossover, we got a bullish center line or zero line crossover. And up here you can see that the price action began to change and move positive. That gave us a positive, a bullish signal line crossover. And then we got a bullish zero line crossover, which meant that, like we said earlier, those moving averages are back in bullish order, which gave a good, nice bullish price action run here in an uptrend. And vice versa, you can see the bearish crossovers in the same fashion and the same bearish price action movement. So you can actually catch this both directions. If you're on the right time frame and you're watching. Centerline crossovers can also last a few days or months. It really depends on the strength of the trend and the momentum. And also MACD will remain positive as long as there's a sustained uptrend. So the MACD will remain negative when there's a sustained downtrend. This could have remained negative forever if this downtrend would have sustained. I do ask that you please continue to watch the series to review basic indicators that we're going to cover, so that on the next series, when we begin adding them all together, like you see here on my chart, you'll be able to utilize them to make multiple signal confirmations. You need to have a firm grasp on the material before we get into that. And again, we'll cover convergences and divergences in the next series because they can get a little more complicated and confusing as well. I just will go ahead and note, though, however, in our past video series that we've monitored, we covered RSI. You see an oversold area here, gives you a buy signal. Then we get a bullish signal line cross. Then we get a bullish zero line cross. You could have made a small entry position here, added to that entry position here. That would have put you entering this trade long here, adding to the position here. And once you got this zero line crossover, meaning the moving averages were back, that really confirmed some bullish momentum for you. You could have really dumped in a lot more money here and taken the exit once RSI got oversold and gave a sell signal, and you also saw the MACD histogram where the lines begin to converge or get closer together. So this was a sell signal, this was a sell signal. So you bought more, boom, up, get a sell signal, close out half your position, MACD starts to degenerate, close out the rest of your position. That's profit all the way up. Happens the same way on the way down. This should really give you a basic understanding of MACD and how it applies to confirming trends and momentum, how we're going to use it in the future with other signal generated signals. Excuse me. This very important indicator gives professional traders the signals for making the right decisions on both sides of the market. If you've enjoyed the past videos or you enjoyed this, you learned something new, would like to join a noise-free, friendly, and productive trading environment, please feel free to come to growtradingschool.com and check us out. Come in for a 5-day free trial. I think you'll really enjoy it. You can trade, learn, and view charts with us all. Thanks again.